Hello and welcome to today's daily educational here at Forex.Academy. I'm your host, of course, Robert Blackwell, and have the pleasure today to walk you through your daily education. Now, before we do so, please consult the following disclaimer. We'd like to make it aware there is risk involved trading the financial market, so please have a look through the following disclaimer and do be aware of the risks involved. Now, the content of today's particular trading webinar, of course, we're going to discuss long-term trading. Now, there are significant advantages to long-term trading over short-term trading. One of the most, I suppose, important examples that I can give you is that many traders do not like to involve themselves in what they call short-term risk or volatility in these financial markets. So effectively, when you're taking a long-term position, you're able to trade through the white noise or trade away from the white noise of short-term volatility and market participation there in the short term, and look for overall strategic goals for your trading. Okay, so what I'm going to do is just walk through two potential trading opportunities here, and we can discuss how we can inevitably look to trade them in the long term. Again, the main focus of financial markets is, of course, to profit, but you might find your trading strategy is best suited to long-term trading strategy. Some people do get caught up in the markets and overtrade, of course. Long-term trading is one method that will help you to uncover your idea in terms of the fundamental approach to the market, define an overall trend structure perhaps, and something that you'd like to trade over that long term, given that you have some sort of a fundamental backing to supplement the trade. So let's discuss here a long-term trading opportunity in the FTSE 100 and inevitably what's happening at the moment here in the UK. Well, as the dollar appreciates, sterling depreciates with the Bank of England holding off on interest rate increases. So that was some relative news flow, of course, over the past 2 months there. We have seen the US dollar appreciate, but we've also seen significant depreciation in sterling, i.e. the cable market has traded very strong to the downside. So our cable market is, of course, our pound sterling against the US dollar forex pair. We've seen that depreciate quite a bit in the last 2 months. Why might that be supportive of the FTSE 100? Well, because it's priced in pounds, of course. All of those shares in the FTSE 100 are priced in pounds. When the value of that pound effectively decreases or depreciates, well, those shares are now better priced or more attractive, so they need to be recalculated, they need to be repriced in terms of the overall asset liability as a function of their currency. Okay, so we also see the European equity prices or the European equity markets at this time particularly show some growth. They've been supported by economic growth, and the economic news figures have been quite strong as well, and they've started to tick up to the upside as well after quite a large correction. So this is all factoring in to our trading decision. What we may look to do is decipher a technical break here. So again, we have seen sort of similar price action here where we're not sure what to do. And I'll just highlight this on screen here. Here we have the big sell-off. Then we have a bit of a bounce, but the market is observing volatility at these highs and again cannot reach our evidential high and trades to new lows. Okay, so that does not give us a sign to look for a technical break. However, when the market trades up in and around here, it becomes questionable. When we get the break above this candlestick here, again, that is our signal. So roughly around this candle here, we could look to suggest that is a technical break. And again, if we use technical analysis, other forms of indicators to supplement that with our fundamental knowledge of what's happening in the FTSE at the moment, perhaps we can get a trade-off. Now, one advantage to only observing this as a long-term trade is not only entering the market, it's placing your stop loss. Because it's a long-term trade, there would be no point placing the stop loss of the low of that particular candlestick within 1 day. You may like to choose a structural place in the market to place your stop loss. So effectively what we can do with this trade is take a long-term entry above these prices, okay? And then we can say, well, we'd like to risk, this is a long-term trade. I don't want to get caught up in these €5, €10 winners and losers here and there. I want to take a trade on this market. I really think this is an opportunity for me. My stop loss is below the last corrective low here and is a €100 stop loss. Okay, so I'm trying to trade this for some profit. Evidently, we see the market trading strong, and now the trend is confirmed with the technical break here. So we've had a bounce from the low, but albeit this bounce is significantly consistent in relation to previous bounces, albeit we get a bit of fluctuation there with one candlestick, and then we get a break after that one candlestick. You can see this isn't as convincing. This, of course, is only 3 days, and then there's a stronger pullback, and again, more pullbacks and volatility. So we're trying to avoid the volatility with a long-term trade setup. This is what we find. The result of this is then we get, of course, a stronger trend to the upside. And because we've actually thought of this of a long-term trade, guys, the decision has to be resolute. We should not look to simply capture profit here at these prices if we're looking to provide a stop loss of €100. That is a negative risk reward. Or at these prices, again, you could suggest, it's a good winner, but the idea was for a long-term trade in the market. So try and follow through on your trade decisions. Now, evidently, we see the market continue to trade up, and we get a fantastic floating profit here. Again, we're still in this trade. The floating profit is 401.88 from our stop loss there and our long-term entry. So fantastic trade in the FTSE 100. Again, a totally long-term objective. Here's the US 10-year Treasury bond. We may look to trade this to the downside. Why is that the case? Well, of course, we know that interest rates are increasing in the US. We've had 2 this year. We're expecting 4 overall. Of course, guys, we're trying to price in this fundamental move in a market. We choose the US 10-year market. We look towards the yield curve, and we know that there's going to be opportunity in this as a market. Again, fundamentals aside, we know that this is trading to the downside. We can see a very well structured trend in this price action. How might we look to capture some momentum? Well, the trade is positioned to take advantage of the long-term trend whilst avoiding short-term volatility. Again, that's the key. So we have a short-term entry there with this little price action, albeit when we enter, the market pulls back, but we place our stop loss above a corrective low there, okay? Now, given the market's trending so strongly to the downside, albeit it has some pullback material there, our stop loss again is €100. So again, there's no point to take a €60 winner on this trade unless something really significant happens fundamentally in terms of the news flow. There's war or political conflict that is starting to ensue, and you don't believe in the trade, then you can get out. But again, if the reason for entering the trade is there, you're looking to follow this as a long-term trade, a long-term move in the market. And again, if that is the case, you can see movements like this. So can you see for these 2 examples, guys, why there might be more opportunity in actually trading like this, as opposed to selling this 10 times on the way down, whereas you're just simply avoiding that volatility. You might actually take some losers as well. You might sell the market here, it pops way up here, and you might take quite a substantial loser when you're trying to follow the trend in the market, not observantly looking at one single candlestick, which may cause you to get out of the trade. So effectively, we have a short-term entry in this market. We follow the momentum to the downside, and we see now our floating profit is €366 on this trade. It's a fantastic trade, guys, a fantastic trade in actually not going to your trade screens every second or perhaps every day. You could literally trade a market. You have your stop losses in place. You could go to your trades screen every Friday morning or, over the weekend. Of course, you could look to trade this over the long term. During times of market uncertainty, when we see financial crises, of course, you can look towards asset classes like these, the bond markets, the treasury bond markets, to invest or trade those prices, again, for long-term opportunities, because it takes time for recessionary periods to come to light. When they start to come to light, then there's an extended move. So you can position yourselves for such trades in the long term, guys. That is opportunity as well. And we often forgo these opportunities because we are obsessed with the short-term volatility in markets. So I would ask you to perhaps look at some of these long-term trading opportunities, increase your trade size perhaps to give you the exposure that you want as a trader in these markets, and look for profit opportunities in the long to medium to long term. Okay, so that finishes this daily educational webinar brought to you by Forex.Academy. Very enjoyable indeed. Thanks for joining us. We'll see you next time. Bye for now.